Silver just ripped into the high 70s. Gold just punched through the mid 4,000s. And the gold to silver ratio just cracked below 60. That combination is not a normal rally. That combination is a flare gun. Because when gold is screaming system stress and silver starts catching up fast enough to compress the ratio, it usually means the polite phase is over and the violent phase is loading. You're not watching a shiny metal headline. You're watching the monetary system show you the seams. Welcome back. You're watching a straight-to-the-point breakdown of what the market is really signaling and what the next move could look like if big money decides to stampede. Here's the core idea in plain English. Gold is the asset institutions reach for when they start doubting the story. Silver is the asset that explodes when the doubt spreads, and the door gets too small for the crowd trying to squeeze through. And right now, the ratio dropping under 60 is the door narrowing. Most people hear gold to silver ratio and mentally check out. Don't. Because this ratio is basically a stress scanner. You take the price of gold, you divide it by the price of silver, and you get one number that quietly reveals whether the market is choosing stability or preparing for impact. When that number is high, it usually means gold is leading and silver is asleep. When that number compresses hard, it often means the market is transitioning from hedge to panic hedge. And if you're wondering why that matters, even if you've never bought a single ounce of anything, because this isn't just about metals. It's about what people do when paper promises start feeling heavy. Now let's lock the timeline. Late December, silver is hovering around the upper 70s. Gold is pushing above the mid 4,000s. And the ratio is flirting with the high 50s. That's the uh-oh zone. Not because 60 is magical, but because historically you don't see that kind of compression unless something underneath is pushing capital out of comfort and into collateral. And that's the word you need to remember. Collateral. Not investment, not trade. Collateral. Because when trust gets questioned, the system doesn't ask what has the best marketing, it asks what can't be printed. Now, before we go any further, you need the map. There's a 4-stage pattern that repeats through monetary history so consistently it's almost boring until it's happening to you. Stage 1, credibility. Stage 2, expansion. Stage 3, breakage. Stage 4, repricing. And the scary part is not that this pattern exists. The scary part is that stage 4 never feels like stage 4 while you're living in it. It feels like a weird rally. It feels like a temporary spike. It feels like surely they'll fix it. And then the measuring stick breaks, and everything that can't be printed becomes more expensive. Not because it changed, but because the unit measuring it got diluted. So let's build the foundation you're standing on. Global debt in recent years has been cited around the $250 trillion range. That's not a headline number. That's a trap. Because when debt reaches that scale relative to the real economy, policy loses freedom. You can't hike rates high enough to truly defend purchasing power without snapping the debt structure. You can't print your way through the debt burden without leaking purchasing power. So the system ends up boxed into the least politically painful option. And the least politically painful option is almost always the same. Quiet debasement, a slow transfer, a stealth tax, inflation doing the dirty work nobody wants to vote for. Now here's where gold and silver start acting like smoke detectors. Gold tends to move first. That's the cautious money. We're not saying it's broken, we're just hedging money. Then silver starts moving when the market realizes the hedge is turning into a necessity. And because silver is smaller, tighter, and more fragile, it doesn't glide. It snaps, it gaps, it whipsaws, it shocks. That's why the ratio matters. Gold can move without breaking the room. Silver moves and the room shakes. Now I'm going to walk you through those 4 stages using 3 historical scenes. Different eras, different empires, same mechanism. And once you see it, you can't unsee it. First, Rome. In the early days, the coin worked because the metal was real. You could travel across regions and the coin still held trust because it had substance. That's stage 1, credibility. Then comes stage 2, expansion. War costs money, administration costs money, bread and stability cost money. And when the math doesn't work, the temptation appears. Shave the coin, reduce the purity, keep the face, change the substance. At first, people barely notice. That's the genius and the evil of debasement. It looks the same, it spends the same, until it doesn't. Then stage 3 hits. Crisis stacks on crisis. Political chaos, external pressure, internal instability, and the debasement accelerates. The coin becomes a shell with a costume, and people adapt the way humans always adapt. They stop trusting the stamp, they start trusting the weight, they demand real goods, they hoard better money. They raise prices not because they're greedy, but because they're trying to survive the collapse of a measuring stick. Then, stage 4, repricing. Authorities try control, price edicts, threats, blame games, but you can't legislate confidence back into a broken unit. When money is failing, people don't negotiate. They flee. Second, Weimar Germany. Before the war, there was structure, a monetary anchor, a sense that savings meant something. That's stage one. Then stage two, debt and promises, war financing. Borrow now, pay later. The later was supposed to be victory. Then stage three, loss, reparations, production disruption, revenue collapse. And the state chooses the path that avoids immediate default, print. At first, it feels like relief. Then it turns into a furnace. And stage four arrives like a guillotine. Prices don't rise, they detach. Savings don't shrink, they evaporate. And society abruptly learns that paper claims are only as good as the credibility behind them. So people move into anything real. Hard goods, foreign currency, assets, anything not chained to the collapsing promise. Third, the post-Breakouts system in the 1970s. After the war, a new system is built. The dollar is tied to gold in a way the world agrees to trust. That's stage one. Then stage two, expansion, deficits, spending, promises. Dollars spread globally faster than gold reserves can support. That gap grows. The promise becomes mathematically strained. Then stage three, the moment the system admits the math, the gold window closes. Convertibility ends. And the 1970s become a decade where inflation teaches a brutal lesson. You can't print purchasing power. Stage four shows up. Gold reprices, silver reprices. Not because the metal changed, because the currency's credibility changed. And here's the part most people forget. Silver didn't politely climb. Silver detonated. It ran from single digits toward the neighborhood of $50. Gold surged too. The ratio compressed hard, and when the stress got too visible, the system fought back. Rules changed. Margins shifted. Forced liquidations hit. Volatility became a weapon. A lot of people learned the wrong lesson from that. They saw the crash and assumed the story ended. But the crash wasn't proof the pressure disappeared. The crash was proof the system will intervene when the mirror gets too honest. Hold on to that thought, because it matters for what comes next. Now bring it to today. After 2008, we entered a new era. Rates pushed toward zero. Asset support became policy. Balance sheets swelled. Markets trained themselves to expect rescue. That was the new stage one, a new credibility built not on restraint, but on intervention. Then stage two went nuclear in 2020. Massive fiscal response, massive liquidity, a surge in money growth that by many reports hit levels we haven't seen in modern history. And the moment you do that, you borrow from the future. You pull demand forward. You inflate assets. And you set the stage for stage three. Then inflation showed up loud, and the public got told a comforting story. It's temporary. That story died fast, because once inflation psychology spreads, it's hard to unteach. So now we're in the trap. Raise rates too much. The debt structure screams. Keep rates too low, purchasing power bleeds. And with global debt sitting at structural levels, this isn't a normal cycle anymore. This is a regime where stage four doesn't need permission to appear. It arrives when confidence tilts. Now look back at what's happening right now. Gold is printing extreme highs. Silver is ripping. The ratio is compressing. That's not a random cocktail. That's the market whispering, collateral is being repriced. And this is where people miss the real danger and the real opportunity. Gold is a deep ocean, huge above-ground stock, massive institutional ownership. Central bank demand, it can absorb flows. Silver is not that. Silver is a tighter pool. More of it gets consumed. More of it gets scattered into products. More of it becomes unrecoverable in the short term. So when investment demand spikes, silver doesn't have the same cushioning. It reacts like a pressure valve. That's why silver has the reputation it has, not because it's a crazy asset, but because the market structure is fragile. Now let's talk about the part that could turn this from interesting into historic: institutional flows. You've probably heard the whispers, big money's coming, mass allocation, huge orders. Here's the truth. You don't need a conspiracy. You don't need secret coordination. You just need the same risk models to flip at the same time. Pensions rebalance, index products rebalance, trend systems trigger, funds chase momentum, endowments hedge, sovereign pools diversify. Each one is small relative to global assets. But in silver, small is not small, because silver is the theater with one narrow exit. Now here's a statistic that matters. Silver-backed products have seen periods where inflows stack up fast, with holdings around the billion-ounce range in recent datasets. Physical bar and coin demand also swings wildly depending on fear levels. That tells you something important. When confidence is calm, people ignore silver. When confidence cracks, people don't tiptoe, they rush. And when they rush into a smaller market, price becomes the bouncer. It doesn't ask nicely. It relevels the room. This is why a compression below 60 is so loud. It suggests silver is no longer lagging politely. It suggests the crowd is starting to move. Now, I want to ask you something, and I want you to answer it in the comments because it reveals how you're thinking. Do you see silver as money, or do you see it as a trade? Because if you see it as money, you think in cycles and regimes. If you see it as a trade, you think in candles and pullbacks. And in stage 4, candles can make you seasick. Now let's address the question everyone asks at exactly the wrong time. If silver is already high, isn't it too late? That question assumes markets behave rationally during repricing. They don't. Repricing is reflexive. It's feedback loops. It's momentum feeding psychology, feeding momentum. And it often runs way farther than the reasonable people think, until it breaks violently, and then it runs again. Stage 4 is not linear. It's discontinuous. And yes, you can get brutal drops inside a larger move. You can get 20% dumps that exist purely to shake people out. Because volatility is a tool, it's not an accident. It's the weapon the system uses when fundamentals become inconvenient. Remember 1980. Rules changed. Margins changed. Forced selling happened. Not because reality got fixed, because visibility got dangerous. So what does that mean now? It means you should expect turbulence. It means you should expect narrative warfare. It means you should expect headlines designed to make you doubt your own eyes. And it means you should not build your entire plan around it will go up smoothly. Nothing about this is smooth. Now, I'm going to make this practical, not financial advice. I'm not telling you what to do, but giving you the framework so you don't get emotionally hijacked. 1. Stop treating the ratio as trivia. When it compresses while both metals are making extreme highs, that's a sign the market is shifting from hedging to protecting. 2. Understand the difference between gold demand and silver demand. Gold is mostly monetary stock. Silver is monetary plus industrial. And industrial use eats inventory. That creates a structural squeeze when demand rises. 3. Realize that supply doesn't respond quickly. A lot of silver production is tied to other metals. That means even if silver price rises, you don't instantly get a flood of new supply. So if demand increases, price has to do the balancing. 4. Anticipate intervention. If silver becomes too loud, the system has levers, margin changes, regulatory pressure, paper dumps, volatility spikes. That doesn't mean the move is fake. It means the fight is real. 5. Match the strategy to your psychology. If you can't handle violent swings, you need a plan that doesn't force you to stare at the chart like it's a heart monitor. Because in a repricing regime, the chart will try to bully you. Now, here's the cliffhanger. What happens when the responsible money that bought gold first decides it needs silver exposure too? Not because it wants to gamble, because it's trying to balance risk. If even a small slice of institutional portfolios rotates, you could be looking at a wave that the silver market simply can't absorb politely. And that's why the phrase tens of billions matters. It's not the exact number, it's the scale relative to the market. Silver isn't built for that kind of attention. So if you hear talk about massive buying in the next rebalancing window, don't obsess over whether it's next week or next month. Obsess over the setup. Because setups are what create the big moves. Timing is what gets people destroyed. Now let's talk about the emotional trap that wipes out smart people. They think being right is enough. It isn't. You can be right about the regime and still lose if you're forced to sell into a smash. That's why liquidity matters. That's why sizing matters. That's why patience matters. Stage 4 is not a single moment. It's a process. And inside that process, there are traps. The trap is over leverage. The trap is chasing tops. The trap is thinking every dip is the end and every pump is the start. The trap is letting volatility rent space in your head. So if you want to play this intelligently, you think like this. What is the system showing me? What stage are we in? What behavior repeats in this stage? Where are the levers the system can pull? And how do I avoid being forced into decisions at the worst moment? Now, I'm going to say something that will annoy people, but it's true. Most people don't lose money because they picked the wrong asset. They lose money because they picked the right asset at the wrong size with the wrong mindset. They buy late, they panic early, they sell into fear, and then they watch the asset recover without them. That's how stage 4 robs people. It doesn't just transfer value through inflation. It transfers value through impatience. Now watch the ratio again. Below 60 means silver is not just participating, it's accelerating relative to gold. And in past repricing episodes, the ratio can compress far more than people think is possible, because possible is defined by calm markets. In stress markets, possible gets rewritten. That doesn't mean it will compress to a specific number. It means you should stop assuming mean reversion is a law. It's not a law, it's a habit. And habits break under pressure. Here's your second question for the comments, and I really want you to answer honestly. If we get a sudden smash, 20% down in a week, do Do you think it would be a warning to exit or a shakeout before the next leg? Because your answer tells me whether you're trading headlines or tracking regimes. Now let's land this. You don't need to believe anything. You don't need to join a camp. You don't need to become a metal evangelist. You just need to recognize what the market is communicating. Gold at extreme highs is a signal. Silver ripping alongside it is a signal. The ratio compressing under 60 is a louder signal. Together, they suggest stage 4 behavior, collateral repricing. And stage 4 continues until one of two things happens. Either discipline returns, real restraint, real pain, real austerity, so credibility is rebuilt, or something breaks hard enough that the system resets under stress. History doesn't offer many other endings, so don't treat this like entertainment. Treat it like weather. If you see storm clouds, you don't argue with the sky, you prepare. And if you want the next update the moment this setup shifts, whether it's a breakout, a smash, or a policy move, subscribe right now. Short and simple. Subscribe because the next window could move fast. And one last thing. When you see the next headline trying to convince you it's over, look back at the ratio. Look at the behavior. Look at the stage. Because the chart is not just a chart right now, it's a message. And the message is getting louder.